Good afternoon, everyone, and welcome to this Nadex webinar, an intro to Nadex knockouts and call spreads. I want to thank everyone for joining today. Hopefully you like the content. And you know what? Let's just go ahead and jump straight into it because we do have quite a bit to discuss. Before I get started, as I have to do for all of our webinars, I do need to share this disclaimer that trading involves risk and may not be appropriate for everyone, that any trading decisions you make are solely your responsibility and at your own risk. And this is an educational session. Please do not construe anything I say as a buy or sell recommendation. I'm doing this for your education purposes, and that'll become a little bit more clear when I do some demonstrations on the actual platform to show you what we've discussed. I find that when we do a practical demonstration, it helps connect the theory and the concepts to the actual application. And when I do that, I'm going to be on a platform and I'm going to be clicking on some different products. So I don't want you to take any of those as trading recommendations. I'm just doing education. Now, as a quick introduction to me, if you haven't joined before, my name is Todd Rich. I'm the head of education here at Nadex. And just a brief background about me. I joined Nadex back in 2019, and I've been in the financial services space for a while, for quite a while. I did get my MBA and my BA from UCLA, and then I moved from California to Chicago and spent some time on the actual trading floors, which haven't wholly disappeared, but for the most part, they're gone. Everything's electronic nowadays. And then I moved into the exchange space and the brokerage space, spending time at Eurex, Boston Options. I think it was 5 years at the New York Stock Exchange and 4 years at E-Trade before I came over to Nadex. And we've been part of IG Group. If you haven't caught the news, IG has reached an agreement to sell Nadex to crypto.com. And that deal should close early this year. Pretty exciting times, kind of looking forward to it. So more to come on that. Okay, and I am going to tell you right now, and this is, what, a couple of ground rules. Let's go through some housekeeping items because I'm getting questions in right away, and this is fantastic. First, I'm going to give you the agenda for today, and then I'm going to go through the housekeeping items before we jump into it. One, I am going to tell you who Nadex is, just a brief introduction because we have so many new folks coming into our markets. Then I'm going to talk about knockouts, and I'm going to go through knockouts with a lot of detail. Once you understand knockouts, and I actually think knockouts are our most intuitive product, I'll cover call spreads, and then I'm going to do a very practical demonstration and show you. Now, the housekeeping items I'd like to point out are, one, this is being recorded, and you will be able to review this at your leisure. So if I go a little too quickly or you'd like to listen to it a few times to make sure that you absorb all of it, we will make that recording available to you. We record all of our webinars and we make them available on our YouTube channel. I am actually going to show that to you before I do the practical demonstration. So if you aren't on YouTube, you simply go to YouTube, you look for Nadex, and you will find it. We've got a lot of educational content there. In fact, we do some daily market commentary to help you potentially navigate the markets. So there's a lot on the Nadex YouTube channel. I would recommend that you take a peek at it. The other housekeeping item I'd like to take care of before we jump into it, on the right-hand side of your screen, you should see a little question mark with a red 1 in it. And if you click on that, it'll open up the panel on the right-hand side. Those are questions. Please feel free to type in questions. I've already started getting some and I love it. I like that interaction. I will do my best to answer questions as we go. If I can't get to it right then, I will look back at the end and try to answer any of them. And there's a high likelihood that if you have a question, somebody else has the same question. So by all means, please type those in. I will do my best to answer them. And then if for some reason I don't get to one of your questions, you can always email customerservice@nadex.com, but I will cover that as well so that you've got access to all the resources, because truthfully, at Nadex, we're here to help you. And anything we can do to help you, we would like to do. But often the best way to get some help is to ask, and we'll do what we can. All right, so let's really get into it. And I'm going to cover a couple of these things quickly because I want to get into knockouts and call spreads. And just so you're aware, the other product that Nadex has are binary options. And if you missed that, I did that session last week, and you can go back and watch that recording from last week on the Nadex YouTube channel. Again, I'll show you where that is. So quickly, because we have so many new customers coming into our markets, a lot of people come to Nadex and they simply just want to know who we are. And one, Nadex is simply an acronym. It's an acronym for North American Derivatives Exchange. Now, what's important is that we are a properly regulated exchange. We are regulated by the CFTC, another one of those acronyms, the Commodity Futures Trading Commission. Now, we are regulated as a contract marketplace. We also happen to be a clearing organization. Now, the reason I emphasize that is because there are other binary option providers that you might find on the internet. To access them, you may need to put a VPN on to even get to them because they're not supposed to be able to, people in the US aren't supposed to be able to access them. But what I will say is that if you did business with an offshore unregulated exchange, buyer beware. If you had some type of issue, you wanted some type of recourse, you needed some type of remediation, or it might be difficult. Whereas we are a proper regulated exchange, we are overseen by the CFTC. It is the same regulatory body that oversees larger exchanges like the New York Stock Exchange or the Intercontinental Exchange is actually their futures piece. They own the New York Stock Exchange. Or the CME, the Chicago Mercantile Exchange. We are properly regulated. We have government oversight, and all those nefarious behaviors or activities that you might hear about in the binary options world are simply not part of Nadex. We don't have any of that. We do have regulatory oversight. Now, what we've done at Nadex, and this is the questions already coming in, is we've designed contracts for the individual retail trader. Now, what does that mean? They've got there's a couple of benefits for retail traders. They've got a low cost to entry, and they've got defined risk, and that is true of binary options, knockouts, and call spreads. So if you're looking for short-term price action in the markets where you've got a low cost of entry and defined risk, meaning you can't lose more than what you initially put into a trade. So there's none of these surprises where you get blown out and you lose more than what's in your account. That can't happen at Nadex. And I'm going to go through that. And right away, people go, well, what does low cost of entry mean? I'm going to show you on knockouts, and we have a variety of choices on knockouts so that you can minimize your capital requirements. Same goes for call spreads, and I will show you how you navigate that. And for each contract, it does depend. I can't give you a specific number, but you can get into call spreads or knockouts for definitely less than $100. You know, it all depends on which one you pick and what risk reward profile you're comfortable with. So I will get into that for sure as we dive a little bit further into it. So let's start. Oh, by the way, I totally forgot. I do like to mention this again because we have so many new people, and a lot of retail traders like to trade with friends. And they like to trade with friends because sometimes, you know, two heads can be greater than one, right? And it can become a bit of a social activity. So we do have a refer a friend program where if you have a live account, you would get your own personalized link where you could share it with your friends, and if they use that link to open an account with Nadex and they place 5 trades within 30 days of applying for their Nadex account, we will give them $100 and we will give you $100. So they get $100, you get $100, everyone gets $100. You could do that with up to 10 of your friends, and you can end up having $1,000 in your account. Your friends would each have $100, and again, it's a way for traders to work potentially together. So let's define knockouts. And first up, a knockout is simply a contract. It's a contract, and it trades within a set price range, a predetermined set price range. Now that price range is going to have two levels. The low level is called the floor, and the high level is called the ceiling. So very straightforward. You've got a contract, and in those markets, we've got knockouts in gold, oil, natural gas, silver, equity indices, the S&P 500, the Nasdaq. I mean, the Dow Jones, the Russell 2000. We've even got them in foreign exchange pairs. So we've got a variety of knockout markets. And for each one of those, there's going to be, for each product, there's going to be a set range. There's going to be a floor and there's going to be a ceiling. And the contract itself is going to trade between the floor and the ceiling, and it's going to move directly in line with the underlying market. So the price you see for the underlying market is going to be the level that you're buying or selling for a knockout. It is what we call a Delta 1 product. What you see is what you get. There's no premium levels in there or anything of that nature, unlike call spreads, which we'll talk about, or even binary options. And if you don't know binary options, the price you're looking at really is the probability that the contract's going to finish in the money. But again, it's a different kind of a concept where a knockout is very straightforward and very intuitive. So you're going to have that price, that product. It's going to trade between a floor and a ceiling, and it's just like anything else. If you think it's going up, you would buy it, and if you think it's going down, you would sell it. Now you're going to say, how can I sell something I don't own? And that goes to the nature of it being a contract. If you're buying, you're taking a long or bullish position because you think the price is going to rise. You can sell something and take a short position. Even though you don't own it, you can take a short position looking to potentially profit if the price were to go lower. And again, the price is going to go up and down and move between a floor and a ceiling. So let's talk about how they work. A knockout will ultimately expire in one of two ways. It will either settle by price or by time. So let's talk about that. By price, the first is a price-triggered settlement. When you're trading a knockout, if the underlying index, the indicative index for that market, touches either the floor or the ceiling, the contract immediately expires and settles at that value. So if you buy a knockout and you're wrong, and it touches the floor, the price touches the floor, you are knocked out of the contract. You're knocked out in that instance for maximum loss. If you bought a knockout and the price went up and it touched the ceiling, you would get knocked out of the contract. In that instance, you would be getting maximum potential profit. But again, you're knocked out of the contract. It doesn't matter how high it goes, you're knocked out if it touches the ceiling. It doesn't matter how low it goes, you're knocked out if it touches the floor. Now, your profit or loss would be different if you're buying or you're selling and it touched the floor or the ceiling, but it's simply a price-triggered settlement. You're trading the price of the underlying, it moves between the floor and the ceiling, and if it touches either the floor or the ceiling, you are knocked out. That's why they're called knockouts. Now, that's going to immediately beget the question, what happens if it doesn't touch the floor or the ceiling? Now, knockouts are initially set to have an expiration at the end of the week. If at the end of the week, a knockout has not touched either the floor or the ceiling, it will settle at expiration. There is an expiration time, and it will settle at whatever the price is at settlement, and that's it. And if you bought or sold a knockout, your profit or loss would be the difference between where you bought or sold it and its settlement value at the end of the week. So let's talk a little bit more about how they work. All right. And again, I mentioned they initially have a duration of 1 week. Every week we list a bunch of knockouts, and for any particular market, we're going to have 4 knockouts for you to choose from. And there are a couple of reasons for that, and that actually goes back to the question about how much does it cost to do a knockout. I will get into that. But we initially have 4 knockouts per market, and in the event that a market touches the floor or ceiling and a contract settles and it's gone, we will list a new knockout so that you generally will always have 4 knockouts to choose to choose from for each market. Let me grab a sip of water. There we go. Sorry about that. So now you've got 4 to choose from. I'm going to give you a simple example so you understand what I'm talking about. And here's an example of gold. In this particular example, gold started the week at 1820. Now, the range for each knockout for any given market is going to be a little different. Don't worry about that. The actual numbers, we help you on that both on the platform as well as the order ticket. But we will list 4 knockouts. The first knockout will have, we'll just take a floor that's 10 points lower and we'll create a ceiling that's 40 points higher. So there's 50 points in the range of a gold knockout. We'll then create another knockout where the floor is a little bit lower and the ceiling is a little bit lower. And we'll keep doing that until we have 4 knockouts. Now let's take a look at what happens over the course of the week. Here's gold at 1820, where it started the week. And if gold, and there's the end of the week where it will settle at the end of the week. Now, if gold initially were to start going higher, all right, you notice that it starts going higher. Well, knockout number 4 has the lowest ceiling. So it would touch the ceiling of knockout number 4, in which case knockout number 4 is knocked out. It's gone. That contract settled. So if someone had sold knockout number 4 and it went and touched the ceiling, they would have experienced a small loss and they'd be knocked out of their trade. If someone had bought that one, they would have a small profit and they would be knocked out of the trade. And because the price started going higher, we would add another knockout up above so that you would always have 4 knockouts to choose from. Now let's take a look in the case if the price of gold actually started going lower. If the price of gold started going lower, of course, you can see that knockout number 1 has the lowest floor. So I'm sorry, has the highest floor, Knockout number 1 has the highest floor. So knockout number 1 would settle. So if you bought knockout number 1 and it went down, you would have experienced a loss. You're knocked out of the trade. It's gone. And we create a new knockout down below so that, again, you would have 4 knockouts. So you can see how there will always be 4. As the week goes on, knockouts will settle due to price movement, and you'll always have 4 to choose from. Now, at the end of the week, as I mentioned, it might not have touched the floor or the ceiling. And that's why knockouts are actually referred to as variable payout contracts, because it all depends on where you buy or sell and where the knockout levels are if you get knocked out. And at the end of the week, it will simply settle at a price, and your profit or loss would be the difference between where you bought or sold it and its final settlement value. So an example of this would be here at the end of the week. At the end of the week, we had these 4 knockouts that still remained, because there should always be 4 knockouts. And at the end of the week, boom, it's going to settle at a price. And on any one of these knockouts, whether you bought or sold them, your profit or loss would be the difference between where you bought or sold it and the final settlement price. Now let's talk about the concept of knockouts. Why do we have knockouts? And this is the first reason why we offer multiple knockouts with different levels, and we're going to talk about that specifically, and then we're going to talk about the money concept. But the first principle is about risk and reward. And what a knockout is essentially is a pre-built trading plan. You know, before you get into a trade, what your maximum potential risk and maximum potential reward are before you place a trade. And essentially what you've got is you can buy or sell a product, an asset, and you've got natural trade exit levels. It's either a profit target or defined, predetermined risk control. So the very structure of a knockout essentially makes you be a very disciplined trader. It forces you to have that trading plan, which can be difficult for a lot of new traders. And that trading plan is whether you're buying or whether you're selling, you've got a distinct, predetermined profit target or potential profit target, and you've got a distinct stop loss level. So if you buy a knockout and it were to go down, that floor is your distinct stop loss. You buy a knockout, and if it touches the floor, you're knocked out, and it doesn't matter how much lower it goes, you're out of the trade. And so you've got that clear stop loss. Now, if you are selling a knockout, the ceiling becomes your stop loss level. If you're wrong, you thought something were going to go lower, you sold it, but instead it went higher, that ceiling is your stop loss level. Now, the inverse is true for your profit target. If you buy a knockout, that ceiling is your profit target. And a lot of traders, particularly new ones, go, okay, I'm into a trade, I'm making a profit. Where do I get out? Or when would I get out? And they don't even think about that. They say, I think it's going higher and I'm going to see where it goes. And what can happen is it can go up and then it can come back down and you go, why didn't I get out? A knockout will force you to take those profits because it's got a clear, distinct level and you know what you could potentially make getting into the trade, and you're okay getting out for a profit because you can move on to the next trade. It forces you essentially to have a trading plan. Now let's also talk about that risk reward. When you're buying and when you're selling, and that is ultimately going to be, now the risk is ultimately going to be the cost of the contract. When you enter a knockout, when you buy a knockout, whether you sell a knockout, you know what your maximum risk is before you enter a trade. If you're buying a knockout, the maximum risk is the difference between the price level you bought and the floor. If you're selling a knockout, it's the difference between where you sell it and the ceiling. And that is going to be what a knockout costs you. Now, the reward side is pretty straightforward. If you buy a knockout, your reward is it goes up to the ceiling. You sell one, your reward is it goes to the floor. Now, I want to show you in a very graphic way or graphical way to understand why we offer 4 knockouts so that you can choose the risk reward profile that suits you. So for example, you thought gold were going higher. So you want to buy gold. You're going to go long gold. You're looking for the price of gold to go up. You might choose knockout number 1. Now, why would you choose knockout number 1? The reason you might choose knockout here's gold, here's where you're buying it at 1820. We know the end of the week it's going to settle, and we know the floor of knockout number 1 is 10 points lower. It's 1810. We gave it to you. We know the ceiling on knockout number 1 is all the way up at 1860, and we know that you're buying at the 1820 price level. Now, what you've done, and you can see very clearly the risk reward ratio. Your risk is it goes down. If you were to buy knockout number 1, your risk as it touches the floor, that is the red area. Now, the reward potential is the green area up above. Now, we offer 4 different knockouts because you can choose the risk to reward ratio that suits your appetite. So knockout number 1 might have a little, maybe you're willing to take a little bit more risk. You're willing to take, because you don't want to get knocked out if it were to dip down a little bit, but you still think it's going to go higher, you may choose knockout number 2. You're going to have more risk. The red area at the bottom is going to be larger. Your green area, your profit potential, is going to be smaller, and that would be the risk to reward ratio. And you can see it very clearly. That's up to you to decide how comfortable you are with your risk levels versus your reward levels. And that's why we offer 4 knockouts. Now, conversely, I want you to see selling a knockout. Here's the same example, but you thought gold were going to go lower. If you were thinking gold were going lower, you might choose knockout number 4. Now, why would you choose knockout number 4? It's got the lowest ceiling, so it's going to have the least amount of risk if you're going short, if you're selling. So here's that same chart. Now, knockout number 4, the ceiling is much lower. It's all the way down at 1830. The floor is much lower. Notice there's 50 points of range in there. And we know we're selling at the 1820 level. This is, I think it's going lower. My risk is the red area up above. My potential reward is the green area down below. And again, if you thought gold were going lower and you were prepared to take a little bit more risk because you wanted to have a little bit more wiggle room in your stop, which is the ceiling, you might have chosen knockout number 3, where there is more risk, a little less reward, but you've got some room in there where you won't get knocked out so quickly if it just goes up a little bit. So you've got to choose which risk reward profile suits you. That is one reason why we offer 4 different knockouts. Now, the other reason we offer 4 different knockouts, and this goes straight to the question we had right at the beginning, is cost. Is what is it going to cost? What are your capital requirements? Your capital requirements are the maximum risk when you place the trade. All right, so if you buy it, it's that red area down to the floor. If you sell it, it's the red area up to the ceiling. You know what that is before you enter a trade, and you've got to look at the knockouts that are available to trade, make a determination. Am I interested in buying and going long, or am I interested in selling and going short? How much risk am I willing to take? And you can manage your capital requirements. You can decide how much money you're prepared to potentially put into a trade. The capital requirements are your maximum risk. Once you put that into a trade, you will never get a margin call. Nadex it doesn't move around, and then we adjust margin parameters and have initial margin requirements and maintenance margin requirements, and all those concepts that people may or may not be familiar with futures simply don't exist in Nadex. You know what your risk is. It is defined before you get into a trade. If you need help calculating that or seeing that, we will show that to you on the order ticket. So when I get over to the practical demonstration, you'll see when you're on the platform, you'll know what it would cost for you to get into a particular trade. And this is true whether you're buying or whether you're selling. So the second reason that we offer multiple knockouts is so that you can minimize your capital requirements. Depending upon how much trading funds you've got, if you want to use knockouts, you can always choose the knockout that's got the least amount of risk so that you can maximize how you leverage your trading funds by minimizing your capital requirements by choosing knockouts with the least amount of risk. Now, on an order ticket, and again, this is going to go to dollar value. This happens to be an order ticket for crude oil. And at the time, crude oil was all the way down at $70 a barrel. Now I know it's above 80. It's up at $82 a barrel. And what you've got on an order ticket is you've got the indicative price. That's the price of the underlying. That was the price of oil at the time I took this example. And I obviously took this example on a Tuesday because there was almost 4 days left until expiration. Now we've got at the top of the order ticket the floor and the ceiling calculated for or shown to you. Now it's even easier when you look at a chart. It's very visual. We will take a look at that in a moment. But you can see that at this moment in time, oil was trading at 70.62, which is between the floor and the ceiling. All right, and I've got my levels where I could either sell or where I could buy. Notice with oil at 70.62, it is the bid and the ask are right around that price. All right. If I wanted to buy oil, I would have, I could buy it at the 70.66 level. If I wanted to sell this contract, I would sell it at the 70.59. Now, if I were going to sell oil, I think oil we're going to go lower at this moment. That's why the order ticket is red. I could choose the price that I would potentially be willing to sell it at. Notice that the price I'm willing to sell at is going to be very close, within a penny. I could have offered this at 70.62, right where the indicative price is right now. I could have offered it at 70.66. We have what's called an open central limit order book. All that means is that anyone could put a bid or an offer. And if you wanted to buy it, you could put a bid between the bid-ask spread or with the bid or down below. If I wanted to sell it, I could sell it between the bid-ask spread. I could sell it at the bid-ask spread. I could try to sell it above. Now, if I were to place an order at 70.61 trying to go short here, would I necessarily sell it at 70.61? Not necessarily. Someone would have to come and want to buy it from me. I know if I actually wanted to sell right now, I would have to sell it at 70.59. There is a bid there. I could sell at 70.59, but I'm allowed to place an offer in between the bid-ask spread, advertising my price, my willingness to potentially sell it at 70.61. Now, if I sold it at 70.61, we calculate what your risk and reward are. If you sold it at 70.61 and it went up to the ceiling, 71.25, we know that's the ceiling, I would lose $64. That is my cost to enter this trade. I would have to risk $64. Now, what's my potential reward? My potential reward would be if oil went down to 66.25, and if it went all the way down there, I would get knocked out for a $436 profit. Now, notice in oil, it's a $500 spread. The spread or the range for different contracts varies. And you'll see that on the chart, but we also calculate that for you on the order ticket so that if you're not sure what the spread is on any particular product, you'll be able to see it on the order ticket. Now, to be clear, I want to be clear here. Give me 1 second. The question we've got are 66.25 and 71.25. What are those? Those are the floor and the ceiling. All right, that's what we do. We give you the floor and the ceiling of this knockout. So if I were to buy this knockout, I would get knocked out if it went down to 66.25 for a loss. If I were to buy it and it went up to 71.25, I would get a profit up to 71.25. Now, when I show this to you on our charts, it will be easier to see. I just wanted to show you on an order ticket that we give you the floor and the ceiling. You see the indicative price now. And if I were to, because this is right now, if you notice, the indicative price is very close to the ceiling. That's why I said, hey, maybe I'd be prepared to sell it here if I thought oil were going lower. If I thought oil were going higher, I would probably choose a different knockout. I would choose one with a higher floor and a higher ceiling, one where the floor is much closer to this price. And again, that's why we offer you 4 choices. And we do calculate that potential profit and loss for you. Now, before I wrap up with knockouts, because you do have that clearly defined potential profit and loss built in. And when I show it to you on the chart, you will see it much more clearly. I know sometimes it's hard to kind of grasp what it looks like, but when you see it on a chart, we make it very easy for you. Now, this is really important. This is a slide I'm going to share twice. I'm going to share it once right now. And this is an important rule when trading knockouts. And this is true for binary options and call spreads, which is why I'm going to share this twice. But just because there's an expiration associated with the contract does not mean you need to wait until then to see what happens. That is really important. You can choose to exit a position early if you want. Now, why would you potentially exit a knockout early? Well, you might take a partial profit. If you bought a knockout and it went higher and you were making a profit, you might just choose to simply sell it and take a partial profit. You don't have to wait for it to try to go all the way to the ceiling for you to get maximum profit. You can, you certainly can look for maximum profit, but you can certainly take a partial profit. If you were to buy one and it went up, you can always sell it and say thank you very much. You could also get out early if to cut losses. If you were to buy a knockout and you know you're stopped at the floor, but it starts going down and you decide, you know what, I don't like that. I was wrong. You don't have to experience maximum potential loss. You don't have to let it go down and touch the floor and knock you out. You could try to, or you could choose to simply sell it, take a partial loss, and move on to your next trade. So hopefully that is clear. I am going to emphasize that point, and I will show that to you as well when we get over to the platform. Now, if you understand knockouts, they're a Delta One product. You buy it if you think it's going up. You sell it if you think it's going down. You choose the knockout where the risk-reward ratio suits your appetite, where you manage the amount of risk that you're taking versus your potential reward. And you can also choose the proper knockout that maximizes your capital utilization, the leverage that you have on your funds, by minimizing how much it costs to put on a trade, by choosing a knockout with the least amount of risk. You know, if you're buying one that's got the highest floor. If you're selling one, it's got the lowest ceiling. Now, if you understand knockouts, call spreads should be pretty easy to understand, because a call spread is also a contract, and it also has a predefined range, and those range, they've got a floor and they've got a ceiling. So very, very similar to a knockout. In fact, the value of a call spread will move in line with the underlying, similar to knockouts, but not the same. And call spreads differ from knockouts in two very important ways. And this is what makes call spreads different than knockouts. One, a call spread only expires at expiration. There is no price triggered settlement. So if you're trading a call spread and it touches the floor or the ceiling, you are not knocked out of the trade. You are still in the trade. So if it goes against you, it gives you more time for that contract to change direction and for you to potentially be right. All right, so it's got optionality baked into it. Because it has that optionality, volatility and time to expiration will impact the price of a call spread. There is going to be a premium in a call spread. Now, I'm going to show you how people tend to use call spreads, because a lot of people, when they're looking at call spreads in order to minimize their risk, sometimes they'll buy a call spread that is below the floor already. It will cost them the least, and they're looking for it to go up and potentially profit by going higher, but it's a way for them to minimize how much capital they have to put in. Now, there is going to be, obviously, it's already below the price, so there's going to be a premium in there that you're paying. Or if they're going short, they might sell one that's at or near the ceiling. So I will show you some examples of that so that you can understand the different nuances between why you might choose to trade a knockout versus why you might want to choose to trade a call spread. Now, on a call spread order ticket, very similar to a knockout where we've got the indicative price, we've got the timed expiration, we've got the floor and the ceiling. Now notice, here's me trying to say I would like to sell oil. Again, take a short position in oil. Notice that oil is already above. It's up at 70, 60. It's above the ceiling. The ceiling is 70. It's trading above the ceiling. And if I want to sell it, I would have to sell it all the way down at 69, 67. All right. Now, why is that? That is that premium level. That is that optionality where I'm selling it. And if it were to go up, now, if I were to try to sell one at 69.73, let's say I sold one at 69.73, We know it's already at 70.60, right? We're looking for it to go lower. It would cost me $27 to trade one of these. That would be my risk. Now notice though that it would have to go from 70.60 down quite a bit for me just to break even. But for me, I'm looking for it to go lower. That $27 right now is all premium, right? But I've got time. I've got 18 hours, and I'm looking for it to go lower. And I know my maximum profit, because it's a $5 call spread, $5 between the floor and the ceiling. The contract can't be worth more than $500. So I know if I'm risking 27, I could potentially make a total of 473. We calculate that for you, whether you're going short and selling or whether you're going long and buying. Again, I will demonstrate that. Now, I am repeating this again. This is very important, and in fact, with call spreads, it's almost more important. Is just because there's an expiration associated with a contract does not mean you need to wait until then to see what happens. Now, with the call spread, I buy it. If it goes down, I know what my risk was to begin with. I knew how much I could potentially lose. But if it goes up, I know what I could potentially make. Now, unlike a knockout where I am knocked out of the trade, a knockout, I'm knocked out for a stop loss, I'm out. A call spread, I'm not knocked out. I'm still in the trade. But on the profit side, if you buy a knockout and it touches the ceiling, you're forced to take those profits. On a call spread, you are not forced to do so. So liquidating a position early, getting out of a position early might be important with a call spread. If you bought a call spread and it went up through the ceiling, you know there's still going to be some premium in that, right? Because it could still turn around and go the other way. But you're not knocked out. You're still in the position. And if you don't sell it, it could come back down and you would have missed your opportunity to profit. So taking and locking in those profits by exiting the position early for call spreads becomes important. Conversely, if you sold a call spread, you're looking for it to go lower. If it were to go down to or through the floor, you're still in that trade. You're not going to automatically take those profits. You would have to buy it back and close the position. Otherwise, you're still in the position all the way till expiration. So exiting a position early becomes really important. And I know that people do that in binary options. They certainly do that with call spreads. With knockouts, it's also important, but it's not as critical because with a knockout, you actually have pre-built exit points built into it. So if it goes against you, your losses are stopped. And if it goes your way, you're going to be forced. And if you step away from your computer, and you're not paying attention, and if you would have had a profitable trade with a knockout, you'd be knocked out. You go, oh, look, I got maximum profit. With a call spread, you'd actually have to have an order in there to liquidate it. Otherwise, you might have missed your opportunity. I am going to show you how to manage that on the platform. So now I'm going to do the practical demonstration, and I think it helps solidify everything that we discussed, and it helps you visualize it and see it on the platform. If you've got any questions, please, I think I've answered most of the questions that we've gotten. I see some more have come in, but I'll make sure I get to them when I do the platform. But if you've got any further questions, please email customerservice@nadex.com. I'd also recommend that you follow us on social media. Now, if people ask, is this available? This recording will be available. You'll be able to come back and do it at your own pace. Follow us on YouTube. Go to YouTube. In fact, I am now going to, instead of talking about it, let me show you. And I'm going to switch over here. Quickly, I'd just like to show you our YouTube page. If you haven't gone to YouTube, simply go to YouTube, you search for Nadex, and you'll find Nadex. And I would recommend that you subscribe to the channel. You subscribe to the channel because you'll get notifications on YouTube when we post additional content. Now, if you go to the videos section, you'll see last week, there it is. There's the introduction to binary options. So if you happen to miss the session last week, you can go and listen to the session I did entirely on binary options. Today I did call spreads and knockouts. That will be located up here as well. The other thing I'd like to point out, and you may not be aware of it, but every day, I'm going to go back to our home screen. Every day, Let's put that on pause. Every day we do a live stream. Every day we do a live stream on YouTube. It's at 7:45 a.m. Eastern. And what we do, it's called Morning Market Movers. And with a partner of ours, Brian Caprice at Keep Trading Simple, we do some live analysis for potential hotspots that might be apparent in the market for that day. Where might you want to look? You know, what news events do we have for the day? What economic reports do we have coming out? And then we do some technical analysis. If you'd like to review any of our past live streams, please, you can listen to the one from this morning. If you miss them, if you happen to miss one, you can always catch the recording right here under past live streams. And you can see our upcoming live streams. By the way, I've only got one listed. Later today, I'm going to put up the ones for next week. And you can set a reminder. In fact, if I go to the video section and I look at uploads, this is where you'll see all videos. You'll see this particular session. But if you were to go to upcoming live streams, you could see, oh, what's coming up, and you can set a reminder, right? And you could do that if you also subscribe. And if you wanted to see our past live streams, every morning, 7:45 a.m. Eastern, we just stream live for about 15, maybe 20 minutes, and you can get some live analysis for day trading on what potential hotspots might exist in the market for that day. All right, now let's get over to the platform for knockouts and call spreads. I am not doing a full-blown platform demonstration. If you look at upcoming webinars on the Nadex website, next week my colleague Adam McCaden will be doing a platform demonstration of all the functionality. I think a couple weeks after that, he's going to be doing one specifically on charts and how to use and leverage the functionality on our charts. So definitely pay attention and be aware of that. Now, first, I'm going to take a look at knockouts. And I like to show you these so that you can really visualize how you can trade knockouts. So to begin with, I'm just going to choose a knockout in an index. I could choose Forex. I could choose any of the commodities. I'm just going to go ahead and pick the S&P 500. Why not? Notice how we've got 4 knockouts. And I'm going to click on any one of them because it doesn't matter which one I click on. And I'm going to show you why. Let's take away some of my, let's delete that. When I do this, let's make this a little bit bigger. And I'm going to zoom in. Okay, there we go. Notice on the left-hand side of the chart. This is a chart of the S&P 500. Looks like we've been selling off some today. Notice that we've got 4 vertical blue lines on the left-hand side. Those are your 4 knockout levels. If I thought the S&P were going to bounce here, go higher, I might choose knockout number 1. Well, no, it looks like this one's about, yeah, can you believe it? We timed it just right. That knockout just got knocked out and disappeared. If you saw that, it literally just touched it now and it disappeared. We've only got 3. So why do we only have 3? We just listed a new one, so I'm going to click back on the, let's refresh. I've got to refresh my levels. All right, let's go back to indices, go back to US 500, go back to the S&P. We're in the process of adding the 4th one. The 4th one will get listed momentarily, and we should watch that get listed as this one got knocked out. So now, if I thought it were going to bounce higher from here, I might choose this knockout because it's got the lowest floor. All right. And if I were to buy this, all right, I know right now that if I were to buy this knockout, all right, I know my floor and my ceiling. I know my floor is 46.69. All right, that's here on my chart. Notice how it's very clearly marked on my chart. It's also clearly marked on my order ticket. The ceiling, 47.19. Ceiling, 47.19 on the order ticket. If I were to buy one, let's say I were to buy one of these at 46.78. Let's put, man, it's going lower quickly. So let's just put 46.77 for a second. Oh, now it's ticking back up. Let's put 46.78. All right. If I wanted to buy one of these for 46.78, I know that I could not lose any more than $90 because if I bought it at 46.78, it can only go down to 46.69 and I'd be knocked out. I'm risking $90 to potentially make 410 if it were to bounce back where it was earlier in the day. Now, if I thought this were going lower, I might choose this knockout, right? And I would choose this knockout because it's the one with the lowest ceiling. So if I sold this and it were to go up, now let's just do my calculation. Now notice this is right in the middle of the range. So right now there might not be a knockout well, there should be one more knockout down here. In fact, let's go back. I want to refresh. Now I am in a demo environment. Let's refresh. Let's go back to S&P 500. Why am I not getting that fourth knockout right now? Yeah, that's interesting. Okay, well, in the demo environment, we're obviously not getting that fourth one back up there quite yet. So in any case, let's try to find a different knockout where there's one where the ceiling is closer. Let's take a look at the NASDAQ. All right, so now I'm just looking at the NASDAQ. We've got 4 here. We're gonna watch this knockout as well. Oh, it got really close. If I thought the NASDAQ were going higher, I might choose this one. All right, and it seems to be bouncing a little bit right now. Again, now a NASDAQ has got a 600. It's got a 60-point range. Actually, it's the tick value is different, so it's got a $600 range. Each knockout is going to have a different total notional value. If I were to look at, for instance, let's take a look at crude oil. Notice that these knockouts only have a $200 range. Right? If I thought crude oil were going higher, I might choose knockout number 1 because it's got the lowest floor. I mean, it's got the highest floor. I keep saying that. It's got the highest floor. If I thought oil were going to go higher, I could potentially buy this knockout. If I thought oil were going lower, I probably would choose this knockout because if I were to sell it, I know I'm minimizing my amount of risk, 46, and maximizing my potential gain. And again, you can clearly see that on the chart with the floor and the ceiling. Now, I mentioned exiting a position early. I'm going to now move over. Let's pick a different product. Let's take a look at foreign exchange. Let's look at the euro US dollar. Again, notice there's always 4 knockouts. So let's just use a long example, okay? Let's say I thought the euro US dollar were going to go higher. So we're going to see dollar weakness, euro strength. I might buy one of these, right? And look at this. It's a very tight spread. I'm going to go ahead and buy one, okay? I bought one at one spot 1462, and we can see that in my position window down here. Now notice, I've only got $24 of risk. It's a $100 contract. I could potentially make $76 if it traded up and touched the ceiling. Right now, if I wanted to take a partial profit, now I bought this one at one spot 1462. Maybe I would want to set a profit. Maybe I'm looking to make $15 on this. All right. Again, not a buy or sell recommendation. I could click set profit and I could say I want to make a $15 profit. I can click and say, all right, I'd be willing to take a $15 profit if it were to bounce up, and I can place a limit order above the market. All right. Now, if you'll notice, I just placed an order to sell one up at one spot 1477, and that would give me a $15 profit if it were to bounce. Now, it might not bounce, but if I were to walk away from the computer and this were to pop up a little bit higher, and it got filled, hey, I made 15 bucks. I know that I can't lose any more than 24 because I bought it at one spot 1462, right? I know I bought it at one spot 1462. In fact, I could sell it right back now and break even. And I know when I placed the trade, I couldn't lose more than $24, and maybe I'm willing to risk 24 to potentially make 15. That's why I used the set profit. Now, if I just wanted to get out of the trade, I could click close order and it would just give me a market order. It would just sell the bid. And it's telling me right now what I would potentially make or lose because the price keeps changing a little bit here. and you're watching it change. Now let's take a look at call spreads to differentiate these from knockouts. On a call spread, let's go to the equity indices. Let's go back to the S&P 500. Notice that I've got different time frames. All right, these can be hourly call spreads. They can be daily. There's different time frames for each one of these. So I'd have to take a look at each call spread. Now, unlike knockouts, let me show my strikes. All right, unlike call spreads where you had those lines defining where you would buy, where the floor and the ceiling were, a call spread shades the region, right? It shades the region. So, I mean, this call spread obviously is way away from where we currently are. We've moved. Now, if I thought this were going to bounce, all right, we are looking for a bounce. We could see the shaded area. This is the floor. This is the ceiling. I think this is going to bounce and go higher. I could buy this S&P 500 call spread. If I were to buy one right now, let's just buy one, and I'm just again, let's just buy one, place an order. Oh, there's my order, 48. Look at that, I might not get filled. You can see how I'm trying to buy one for 46.89.50, and I placed the limit order and I missed. And see, that can happen. Right? I may or may not buy this. Now, in a demo environment, no one may trade with me. In a live environment, that experience might be different. That is one of the differences between demo and live is, it's people do things in a demo environment that they might not necessarily do in a live environment. If I had gotten filled, I know that I couldn't lose any more than $95. And if I did happen to buy it, or if it still might happen, I know I could potentially make $305. It's a $400 range. Now, if I thought the S&P 500 were going to go lower, I might choose a different. And let's just look at the different ranges. Yeah, none of these ranges aren't exactly conducive to my trade. So I would actually probably look at a different time frame because the markets have moved. And this is why with call spreads, you've got to take a look. In fact, this has gone so low right now that there aren't really any call spreads where I think I can make any type of reasonable profit. Yeah, I mean, and as you can see, if I were trying to buy a call spread, it shades the area blue. If I were trying to sell a call spread, it shades the area red. And again, your maximum potential profit or maximum potential loss are calculated for you on the order ticket. And if you were to trade one of these, just like I did with knockouts, I could always use the set profit target or close position on a call spread, just like I did with the knockout. All right, with that, and we've gone almost a full hour, I think I've answered everyone's questions. Again, I recorded this session. Please check it out if you'd like to review it at a little slower pace or go through any particular segments. The recording should be up later today. I want to thank everyone for joining us. Again, I want to remind you, if you've got any questions, please feel free to email us and reach out to us at customerservice@nadex.com. I also want to encourage you to follow us on YouTube, subscribe to the YouTube channel, and please feel free to join us at those morning market mover sessions. And again, if you miss them, you can always watch them after the fact, but it might help you generate some potential trading ideas for what's going on that day. Thank you again for joining today. Thank you for being here with Nadex. I want to wish everyone good luck in the markets.